FXN Trading Group, welcome to Forex and in this lesson we're going to be going over Forex price action basics. Alright, and we're going to be talking about pretty much price action, what it is, how can we use it. I'm going to show it to you on a chart. We're going to talk about candlesticks, how to analyze them. We're going to talk about the candlestick bodies. We're going to talk about a lot of different things today. So we're going to get you a really good breakdown of what everything is when it comes to price action. That way you know exactly what we're talking about and you'll know exactly what you're doing when you're trading these markets. Okay? Everything that you're going to learn, everything that you're going to trade should be based off of price action. So first question is, what is price action, right? So price action is basically a form of technical analysis which involves studying historical price data of Forex pairs to predict where the future price might go. Now, the study of price data is usually performed on price charts. So reviewing, your paired charts of like Euro USD, AUD, USD, of that nature. So price action analysis and trading using price action is widely used and accepted amongst most of the Forex traders. Even hedge funds, banks, and other trading funds also use price action analysis as well. So pretty much everybody, you can say, uses some form of price action. All right. So what we're going to do is price action itself is just the movement of price, right? It's the movement of price up and down along a chart in the financial market of Forex. All right. So let's go ahead and bring up a chart here, and that way we can get started here. Cool. So what are we looking at here? We're looking at historical price data on Euro USD. Now, this is on a monthly level, so basically each candle essentially represents a month of movement in the market. Okay. Now, the cool part is that you can actually change viewing as far as this is a monthly, this is a weekly view of the same chart, but each candle now represents a week. So the chart's much bigger, and you'll get to see a lot more more details. So the smaller you go, you'll get to see more details. Okay. Now, what are these things here that you see, the blue and red little bars, right? So those are called candlesticks, Japanese candlesticks actually. So they're a way to display price data when studying Forex price charts. As the name suggests, these Japanese, candlestick charts originate from Japan. They were originally used to trade rice. In the 1990s, candlestick charts started to grow in popularity, and today they're widely pretty much used in the Forex trading analysis, as well as stock and commodities analysis as well. Now, what you're seeing here in the Euro USD is, as price data is basically moving back and forth, this is what we can use to help determine where price is going to be and where price is going to go into the actual future. And we can start predicting price. Now, let's take a look at these candles here, just so you can kind of get a better idea here. Now, the blue candles means that buyers were, this is all just a buyer's market, right? So blue candles represents buyers, red candles represents sellers, okay? So again, red candles, buyers, blue candles, blue candles, buyers, red candles, sellers. All right, now let's take a look at an actual candle, right? So when we look at these candles, what is this candle telling you? Okay, what is this candle telling you? Let's say this candle here, okay? Each candle has an open a close, a high, and a low. Okay, and we're going to break that down for you right now. That way you'll know exactly. So I'm just going to draw one out here for you. All right, so this is essentially your candlestick, right? Now, whether it's blue or red, so let's just say that this is red. Let's just call this a red candlestick, okay? So if it's a red candlestick, what you're going to see is this right here is going to be where the candlestick opened. This right here is going to be where the candlestick closed. This here is going to be the high of that candle. And that right there is going to be the low, okay? So let's write that here real quick. So high, the high is there. The low is here. The open is here. And the close is here. Okay, so this is open, close, the low, the high. So when you're looking at a red candle like this, right, these here are going to also be called, these are called your wicks, okay? So these here are wicks. This here is the body, okay? So that there is the body. This here that is called your wicks. Okay, so that is essentially a breakdown of what the actual candle is, what it represents, what each part of the candle is. Okay, now why do you have these wicks? What are these wicks there for? Why are they there for? Okay, the wicks are there because what this tells us here in this particular on this particular candle is basically price. So they started here, okay, and then climbed up to here, okay, and then went all the way down to here, finally before settling here and closing here. Okay, so that's essentially the life of that candle. So it started here to open here. It first pushed up, so the buyers pushed up price. That creates your high. And then throughout the life of this candle, it drove all the way down and created a low and then settled here. Okay, so that's essentially that's the life of this particular candle. Okay, now let's just say that this candle, just for example purposes, let's just say that this candle was blue instead of red, right? So what does this mean now? So when you have a blue candle, it's reversed. So this would be the open, this would be the close, that would be the high, that would be the low. Okay, so the only thing that reverses is the open and close. So blue candles or bullish candles, they open at the bottom, close up top. The bearish candles, the red candles, they open at the top, close at the bottom. Okay, pretty much the easiest way is bullish candles are going up while bearish candles are going down. Okay, so if it's going up, it's always going to open at the bottom. If it's going down, it's always going to open at the top. Okay, and the same thing with this blue candle as the red candle. So in this case, since this is a blue candle, so it was a bullish candle, what that means is that it opened here, okay, and initially created a low, and then moved all the way up, created a high before settling right here where the actual candle closed. Okay, so that was that particular lifespan of that particular candle. Okay, now this is just one example of a candle, right? Candles have many different sizes, shapes, that you'll see in the market. Okay, but this is essentially the basic layout of the candle. Now, think of each individual candle as like a baby being born, right? Each candle has a begin date, an end date, and a life cycle, right? So these candles here, I'm just going to erase everything here so we can get back to the chart. These candles here each have a life cycle, right? So for example, this candle here was born here. It went up, created its high, drove all the way down, created its low, and then finally died here, right? This took an entire week to happen, okay? As you can see, the very next candle opened right where the other one closed at the same level. You see that? So then same thing. It didn't create any kind of a high because it opened right there. It went all the way down, created the low, and then came back up a little bit, and boom, closed right there. Okay? So essentially that's how the candles work when they go down. So they go down, when you go down, they open right next to each other. When they go up, they still open right next to each other. You see that? So they all go right, literally they open up right next to each other. They just keep going up or down, depending on how price is moving. Okay. Now, very important with Forex and price action is you're going to be analyzing these candles because these candles tell you a story about what happened that entire week, right? If you're looking at a weekly chart, right? So, for example, on this candle here, this candle basically tells me that at the beginning of the week, the bulls were bearish or were bullish, right? Because the previous candle was blue, so that means the bulls had control of price. Price started opened here, right? And the bulls pushed price all the way up here to this level, right? Now, at some time during the week, the bears came in and started to move price down, and they took over the entire price and moved it down to here before closing here. Okay. Now the very next week, bears picked up where they left off here and drove price down even further before closing here. Okay. So this right here, these two candles represent 2 weeks of a bear market, right? Of a bearish market. These two candles here represent 2 weeks of a uh, bullish week, bullish 2 weeks, right? So the bulls had control. Okay. Now, as you can see, each candle are different sizes. The bodies are different sizes. Some of them look like they don't even have bodies. They just have wicks, right? So this is something that you have to understand, and we're going to go into depth on the next lesson as to what each individual candles mean, what they mean, what they do. Okay. Now keep in mind that you can view these candlesticks at different time frames. So we can switch over here at the very top to a daily, and now each of these candles represents 1 day in the market. We can keep going down to 12, 10, 8 hours, 6 hours, 4 hours, 1 hour. We can even go down to as far as 1 minute candles. Okay, so we can get as finely detailed as possible as what we need to. So we can go down to literally a minute candles. Okay, and you can see that I have to stretch them out to even for you to get them to even see here. But these are right here. This is a minute candle. Each of these candles represent 1 minute in the market, right? Let's talk about these wicks here. Let's go back up to an hour chart here, and we're going to talk about these wicks. Okay, so what do these wicks mean here? Let's talk about a couple wicks here. And we see things like this here, right? We see these very long wicks here. What is that about? You know, why are there wicks this long here in the market? Why is that? You know, why are they there? And so these candlesticks here, candlestick wicks, don't just show the high and the low of price for the duration of the candle. They also show where price was for the duration of the candle. In essence, the candle wicks are footprints of the price itself. So, like for example, in this here, and this one here, so in this wick here, right? So for that specific wick there, this is telling us that price at some point during the duration or during the life cycle of this particular candle went all the way up to the 1.17747 area zone, right? And then it pulled all the way back. Sellers were able to push buyers all the way back down, okay? And so you can see the previous candle here, buyers had full control, and they drove price up, and then sellers came in and drove the price all the way back down. So this basically shows the struggle between buyers and sellers. You know, the fight that they're constantly having over price. You know, buyers want to buy it as low as possible, while sellers want to sell it as high as possible. So that's why you see these different candles here that have, you know, these different wicks. You know, like this one here, or like this one here. You know. Like that one there. So all these wicks do is they tell the price, the story of price within that specific time frame. You know, so these wicks, these candles right here in this particular example are, each candle is an hour long. So for an hour, you know, this candle produced a high of 177.48 and a low and close of 173.49. So that's a big move that it made in just an hour. Okay, so compared to this one here, or even the one next to it that made such a shorter move, right? So at some point during the hour, price got up as high as this point, and then it closed at this point. Same with this one, it got as high as this point here, and as low as this point, but closed right here. Okay. So anything else? So now that you know about this, the candlestick bodies, candlestick wicks, we can go ahead and move on to talking about different types of candlesticks or candles, because as you can see, not all of them are the same. Okay, particular ones that I want to mention are going to be ones that look like this. Give me 1 second while I clear this chart out here. And they're going to be candles like this one here, candles like this one here, or like this one here, or even this one up here. So why am I pointing out these candles that barely have either a very little body or no body at all? Okay, what are these candles? Why are they important? Okay, so these are called Doji candles, and that's put this out here for you. So Doji candles is what they're called. Okay, so they're called Doji candles, is what these are called. All right, now Doji candles appear in the Forex market when a candle has the same or very similar opening and closing price. So these are the examples that I'm talking about. Okay, so what happens is with these Doji candles is that price opens, right? Price opens here, goes up, comes down, and then comes back up to where very close to where it actually opened and closed. Okay, so essentially they open and close very close to the same area. Okay, so a candle like this one here pretty much opened and closed at the same price. Okay, whereas a candle like this was very close. It still had a different open and close price. This one again very similar, almost identical. You know, open and close price, and you can see that if I were to put, if you actually pay attention to this right here, pay attention to this up here, you'll see that this will tell you as I go over each candle, it'll tell you the O is for the open, the C is for the close, the H is for the high, and the L is for the low. Okay, so these are the exact numbers. So if I go over this candle, you can see that it opened at 174.14 and it closed at 174.12. This one over here opened and closed, as you can see, in the exact same number, right? You can see the high, you can see the low, and you can see the open and close. Okay, so what do these Doji candles mean? These Doji candles represent essentially the battle that happens between buyers and sellers when they can no longer agree on a price. We end up getting these Doji candles. Okay, typically, and for the majority of the time, whenever we see Doji candles, it could mean that there is a reversal of price coming or a reversal of a trend coming. So, for example, if we look here, price, even down here, we actually have another one. We have another one right here. We have two of them actually next to each other. So you can see that price here was coming down. We have two doji candles, price reversed. And you can see we had a doji candle appear, price went back down, reversed again. Another doji candle, price reversed. Another doji candle, price reversed again. So you can see the game that the data that this gives you every single time that we get a doji candle. Now, the doji candle itself is just an indicator of a struggle between buyers and sellers, right? They can't agree on a price, so the price stays the same. Now, I want you to understand that just because you have a doji candle does not mean that the price is automatically going to reverse, okay? This just tells us that there's indecision in the market, okay? And any time that we have any kind of indecision in the market, there's a good chance, okay, a good chance that we might see a reversal in price, okay, like we have here. All right, so anytime we see any kind of doji candles, it gives us one possible, outcome that we might see a reversal in the market, okay? So just keep that in mind. It doesn't necessarily mean that we're going to get a full reversal in the market. It just means essentially that price is undecided, there's indecision in the market, and for right now, for that time period, there is no agreement upon price, okay? The further up that you go in time frames and you get doji candles, the stronger the indication is of indecision and a possible reversal in the market, okay? So keep that in mind. So let's say if you go to the daily, and if you happen to see a doji candle on the daily, like this one here, or this one, or this one, anytime you see these tiny little candles, it just means that for that entire day, there is indecision in the market. So price went up, price went down, but ultimately they could not agree on a price, and it closed very similar to where it opened, okay? If this continues, you might see that it'll give you a signal for a price reversal. But again, it's not always 100% guaranteed that that's what's going to happen. Okay, but it is something that you do look for in the market because once indecision forms in an area of support or resistance, then you can actually use that as a strategy to trade the Forex market. And we'll get into support and resistance a little bit later. We'll put it all together for you. That way you can see what I'm talking about. Okay? All right. So let's go ahead and now talk about trending markets. Let me explain that to you, what that actually means. So a trending market is basically when the price of a Forex pair, this being, let's say, Euro USD, is trending. When price is trending, it's moving in a general upwards direction or in a general downwards direction. Sometimes this is referred to as a bullish market or a bearish market if it's going down. So we could also say that price is going in an uptrend or price is going in a downtrend. Okay, so let me give you some examples of that right now. Okay, so you can see here that in this particular example on Euro USD, what is Euro USD doing right now? You see that it is essentially going. You can see that it's really just going up, right? It keeps going up, down, up, but in general, it's going up, right? So look, right? The market itself is going up. So this would be considered an uptrend, right? This would be considered an uptrend because it's going up, okay? Now what's a downtrend? Downtrend is obviously the opposite. So this right here would be a downtrend. What do we have? We have price basically just moving down, 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 right? This would be considered a downtrend, okay? So that's a downtrend, and this is an uptrend here. So very simple, very basic. Now, those are just two types of movements that you'll see in the market, right? So in the Forex market, price is doing one of two things. One of three things, excuse me. It's either moving down, it's either moving up, or it's either moving sideways. Okay? So in the Forex market, at any time, the market could be doing one of three things. Downtrend, uptrend, or moving sideways. A lot of times we refer to moving sideways as consolidation, or the market is in a range. Okay, and I'll go ahead and show you an example of that so you know what I'm talking about. So you can see here, this market here is trading in a range, right? So you see that essentially this market is moving between inside of this box here, right? It's not going down fully, it's not going up fully, it's just going bouncing back and forth, almost like if it had a ceiling and a floor, ceiling and a floor, and it just keeps hitting the ceiling and the floor, ceiling and the floor, back and forth, until it breaks out of that and it goes back into a trend, whether it's an uptrend or a downtrend. Okay, so this right here is the market in consolidation, moving sideways, or ranging. Okay. Now, when price is in an uptrend or in a downtrend, price is moving in one general direction. So in the Forex market, price usually doesn't move in a vertical direction, like straight up and down. Instead, price swings up and down, but with a clear, steady direction. So in this case here, you can see that in an uptrend, right, the market's just not moving in a straight line. It's just moving up, down, up, down, up, down, up, down, up, down, up, down, right? So here's where we get into what is it, what are the things that we consider, how do we consider this to be an uptrend, okay? And I'm going to go over that right now here for you. So the way that we consider the market going in an uptrend is if it is creating what we call higher highs and higher lows. Okay, so price starts moving here, and here it creates a higher high. Okay, and then price adjusts again, and now it creates a higher low. Now, why is this a higher low? This is a higher low because price is low, but it's higher than the previous low here, right? So this is a higher high, this is a higher low. Now what do we do here? Here you can see we created another higher high, right? So that's a higher high. Here, what do? We created a higher low, right? And it just keeps doing that over and over and over again. So higher high, higher low, higher high, higher low, right? You get the point. It just keeps doing that. Now it's going to get to a point where, let's say we're here, and it creates a higher high, right? And let's just say if price comes down here, and then comes up, right? So now we get into a position where it didn't turn around like it normally would, like this, to create a higher high again, right? It went straight down and violated a previous higher low. All right, so we have a higher high here and a higher low here. Now, price moved all the way down, let's say, and it passed the most recent higher low. So at this point now, it actually created a lower low, okay? Now let's say price moves back up like this, and then comes back down again. So because it moved back up again, now it created a lower high. This was a higher high. We created a lower low now, and now we're going into a lower high. And then this cycle begins. And this essentially is what creates a downtrend. Okay? So to create an uptrend, we need to be creating higher highs and higher lows, just like this. And in order to be in a downtrend, we need to be creating lower highs and lower lows. So this just, keeps going into a cycle like that. Let me show you again on a downtrend here, so you can get a visual of it. So here it is, and same concept, right? We have a higher high here, we go down and we violate this previous higher low, and now we have a lower low. We come back up, we create a lower high, and then we go down, create a lower low, lower high, lower low, lower high, lower low, lower high, lower low, right? So this creates the downtrend. As long as you're making lower lows, lower highs, lower lows, lower highs, that creates a downtrend. Okay? So that's how you know when you're in an uptrend, and that's how you know when you're in a downtrend. Okay? We look to identify higher lows, lower lows. The higher highs, higher lows, and then the lower highs, lower lows. All right? Now let's talk about ranging markets. Okay? Now, maybe you're wondering why all this is important when we're talking about ranging markets. They sound kind of boring, right? So a ranging market in the Forex market is basically when the Forex pairs are moving sideways or consolidation or ranging, right? Just like I showed you here. Unlike trending markets that are a series of swing highs, swing lows, ranging markets are when the currency price moves between two areas of the market, but in a general sideways direction. Okay, and I showed you what that looked like already here with the Euro USD. Okay, now what happens is, and I'm going to go into another part here of another ranging market so you can see what I'm talking about as well. Here, let's use this right here. So we have right here a ranging market, right? So why is this important? Well, it's important because I would say 75 to 85% of the time, the market is moving sideways. Okay, it is moving sideways. It's moving just like this, sideways, 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 sideways. Okay, the other time is when it's actually trending up or down. But for the majority of the time, we are looking at trading ranges. like this. Okay, now why is this important? It's important because when we talk about trading in a range, okay, when the market is in a range, we're basically trading between a ceiling and a floor. This ceiling here is called resistance. This floor here is called support. Okay, and this is something that we're going to go over in another lesson that we'll get really deep into. But just know that when a market is ranging and moving sideways and consolidating like this, it is moving between essentially 2 points, resistance and support. Okay, using technical analysis is all about understanding where the current price is and where price is likely to be in the future. If future price is going to be higher for a particular Forex pair, then buying and going long on that pair will likely result in profit. If the future price is going to be lower for a particular Forex pair, then selling obviously would be the likely result in profit as well. Understanding how price trends and when price is not trending can help, will help your Forex technical analysis and predictions in the futures. Okay, so in the next lesson, we'll go ahead and talk about price action setups.
Guys, one last thing. Thank you so much for watching my videos. I really appreciate the fact that you take the time to watch my videos. I really hope that I've added value in each of the videos that I make for you guys, and I hope that you're learning something. As always, guys, please make sure you subscribe to the channel. Please like and share the videos if you found value in them. And also, don't forget to visit our website at www.fxntradinggroup.com. Once again, guys, thank you so much. I'm truly blessed.